yield curve spreads, knobs and tuts. Katie, I can't think of a better person to quickly just go over the nomenclature here of what the knob is, what the tut is, what those letters mean, but then also obviously more importantly, what the outright markets are that they're referring to.
Yeah. So this one, I mean, I always talk about like when I was first learning how to trade with Pete, and I've said this before, but like this was the space and still in a way kind of continues to be the space that was like the most foreign to me because of the nomenclature in the previous or in the major contracts that are traded on platforms and things like that. But this one was one where I didn't really necessarily understand how these were structured. But then like once Pete started to explain to me like, oh, anytime there's a change in interest rates or, you know, the rate to borrow or whatever, that should be an opportunity. Like that's all you really need to be thinking about at the end of the day is like, what are these relationships to all these various maturity treasuries to one another? And where can you identify extremes that you can then participate in? So these two spreads are basically separate components of the US Treasury yield curve. And with that, you know, the rate to borrow, and of course, like the reason why the Fed matters is because they kind of help dictate and set that rate. So not only can we see changes in these products during binary events like Fed announcements and things like that, but even when we're in between any type of announcement, we can still find opportunities. Plus, when you couple these together, since they are so highly correlated to one another, you're also giving yourself duration in a trade or an idea that you might have when it comes to short and longer term like interest rates.
Absolutely right. And you nailed on the best word there is relationship, because like interest rates on their own or yields on their own, it's like, oh, I think interest rates or yields, similar term there, are going higher. I buy either the 2-year or the 10-year or the 30-year interest rate and hopefully profit from that. I think they're going lower. I sell that interest rate. When we're looking at spreads, we're looking at those relationships between the 2-year, the 10-year, and the 30-year, because that Fed moves around one interest rate, the shortest term interest rate. But the way that 2 years of durations in interest rates digest that information is going to be very different than 10 years and 30 years. So let's start with this TUT, which has a very, everybody likes these, the names here, the knobs and the tuts. It's like, I'm trading something cool. I've got the inside terminology for, I mean, what were spreads that were pretty much only traded by pros until the last couple of years here. The TUT, Katie, is the 2-year to the 10-year. And what you're seeing here is a really interesting trade over the last several months, whereby the 10-year rate minus that 2-year rate has gone way lower. And we actually saw a yield curve inversion last week and then came back to normal. S10Y minus S2Y gives you that TUT spread, that yield curve relationship. And this is one, Katie, that we looked at buying when it was inverted, because we look at these relationships with an air of reversion to normal. And when we buy that TUT spread, that S10Y to S2Y, what are we actually committing in those two markets? And what are we hoping to happen necessarily?
Right. So, I mean, if you're seeing an inversion or even flat, and when you think about the maturity or the duration of these products, like you would expect that they wouldn't be trading at the same level. So when you're trading this particular spread where you're hoping for it to steepen, you're looking for basically, you know, the 10 years to do this and the 2 years to do this. Or maybe I'm flip-flopping depending on where I am on the camera. But either way, you don't want them to be trading at the same price.
Exactly right. And so when they get too flat or inverted, we're looking at buying that larger duration, the 10-year, and selling the 2-year. So yeah, they steepen, they move further apart in a traditional curve. Now, what's interesting, that TUT, Katie, went inverted and then reverted back to normal. But now the NOB spread, which is notes over bonds, which is bonds being the 30-year, notes being the 10-year. It's just old nomenclature. Don't worry so much about that. Right. But it's just two different pieces of duration now. It's the 30-year minus that 10-year. Now, this piece actually is just as close to inversion as it was when that TUT spread went inverted. So this one now, I think, poses a different, but even as unique or as interesting, opportunity as that TUT to buy the 30-year and sell the 10-year. Same kind of strategy, hoping for the steepening, just two different pieces, right?
Yeah, exactly. So like you said at the beginning of the segment, before you were selling the 2s and buying the 10s, and now you're flipping that and selling the 10s and buying the 30 years.
Exactly right. And it kind of makes sense because the 10s have, in the course of the last couple of weeks, just ripped higher. And so that caused that TUT spread to come back in line because we were long 10s in that spread. And so it came back in line. And now the 10-year has so outperformed that it's outperformed the 30-year, causing this spread now to show some opportunity. Some quick stats here that were actually even more intriguing than the TUT when we were looking at that a couple of weeks ago. Currently, the spread is essentially at flat. It's at 0.05, 5 basis points of difference. Usually it's close to 100 basis points or it's at 0.75 is that long-term average that we're looking for this market to get back to. And the minimum that we can lean against is only inverted by 35 basis points. This is classic asymmetric return versus risk, right? Where historically it's only moved lower by about 40 points, but from an average perspective, it could get up to 70 points higher. And I didn't even look at the max, which I'm sure is probably 100 points higher. I only related the minimum to the average. Got to love a good asymmetric return relative to risk scenario, right?
Of course. So the last piece of this, putting it all together before we jet up on time, each of these is around $400 in buying power. What's a realistic expectation in order to, utilize, and if you put on this position, like what's your profit and loss target?
Absolutely. I think that in a perfect world, you could be like, oh, I'm holding for that average. I'm holding for it to get back to what would be $7.50 worth of difference between 30 years and 10 years. I think holding to get back to like a quarter or half the way to that average is totally fine. So that would be a net P&L, Katie, of about $200, give or take, $50 or $100 there, depending on your aggressiveness. And I think that is trading not only the TUT spread from last week, but the NOB spread for this week. Katie, thanks as always for jumping on and helping with all the information, because this is not easy stuff. And thankfully, you and I learned this from Mr. Molmat a while back. But Katie, thanks so much. And everybody, make sure you catch Mr. Molmat on the next segment, Splash into Futures. Have a great night and a great day trading here, everybody. Peace.